Interested in learning how you can take advantage of your hard-earned benefits with the VA loan? Follow along as we take a deep dive into the most important factors of how to qualify, like credit requirements, debt-to-income ratios, and more. One of the greatest benefits of the VA loan is that the VA doesn't have any specific credit requirements. Without a requirement set by the government, lenders can be much more flexible and often accept lower credit ratings than traditional mortgage products. Even though the VA doesn't have a minimum required score, there are a few requirements they set in place regarding a veteran's credit worthiness. These requirements primarily focus on a veteran's most recent 12 to 24 months of payment history. Here's what the VA cares about. First, if the borrower can show that they have no late payments on their credit report in the last 12 months. Second, if the borrower can prove that they have 24 months of on-time housing payments for either rent or mortgage. If you are a veteran or active duty military member and check both of these boxes, you are most likely eligible to purchase a home using your VA home loan benefit. But what happens if you have not so great credit and are worried about getting approved by a lender? At MHS Lending, not only are our credit requirements much more flexible for VA loans than other loan products, but we also offer VA loans for veterans with damaged credit. We believe every military member and veteran deserves to be a homeowner, and we are committed to offering second chances to borrowers with credit or debt-to-income ratio issues. Because we have no lender overlays, we are able to help clients who normally have a difficult time getting a VA loan. What are lender overlays? Essentially, they are additional requirements applied by a lender to provide another level of protection above and beyond what the VA requires in case the borrower defaults. Without having lender overlays in the way, many of our clients tell us that we were the only company that could get them approved to buy a house. In fact, we've even been able to help clients with sub-500 credit scores use their hard-earned VA home loan benefit. Now let's move on to debt-to-income ratio requirements. Debt-to-income ratio, often referred to as DTI, is the percentage of your gross monthly income that goes towards making monthly debt payments. Essentially, lenders and underwriters will compare how much you owe every month to how much money you earn. You're probably wondering, how do I calculate my DTI? Here's an example situation. First, total all of your monthly expenses that would be on your credit report, including car payments, student loans, and childcare expenses. Then add that to your proposed monthly housing payment to get a total monthly debt number. Next, add up all your monthly income. Finally, divide that total by your total monthly debt to get your DTI. Let's give an example. Let's say you have a proposed monthly payment of $2,000, a car payment of $500, a student loan payment of $350, and credit card bills with a minimum monthly payment of $150 a month. This gives you a total of $3,000 in monthly debts. Then add up your monthly pre-tax income, which in this case is $5,000 because you make $60,000 a year. To calculate your DTI, you divide your monthly income of $5,000 by your monthly debts of $3,000. In this case, your DTI would be 60%. If you were working with a lender not named Military Home Spot Lending, they might tell you that they can't help you because that is too high for them. But because we don't have any lender overlays, you would likely still be approved with us. Now that you know the credit requirements and how to calculate your DTI, let's take a look at VA residual income. Residual income is your income after all bills are paid. This is the main qualifier that the VA cares about when determining how much of a loan a veteran can get. When calculating your residual income, your lender will take into account a lot of things you might not think, like utilities for the home you are buying, the income tax taken out of your paycheck, and other deductions associated with your paycheck. This allows your lender to compare the actual amount of money you have left over to live your life after all bills are paid. The VA wants to ensure that the veteran isn't house poor. House poor is essentially when someone has a really nice house but can't afford to do anything fun because their housing payment eats up the entirety of their monthly funds. In order for the VA to insure the loan, the veteran or service member must meet the residual income requirements. There are a few important factors that go into determining someone's residual income requirement. These include size of the loan, number of people who would live in the home, and where the borrower is looking to buy. Since different parts of the country vary drastically in how much things cost, you may want to ask your lender to help you determine what the residual income is where you live. After you get pre-approved and have found your dream home, it's time to finalize the loan, and this is when you'll need to gather very specific documents for your lender. Here are some of the documents you'll be required to present. A credit report. This helps your lender ensure you have a good credit score and there are no red flags on past credit like bankruptcy or other financial issues. An employment verification to show you how much income you're making now in addition to any anticipated additional income as laid out in employment agreements. Documents that can help with this include W-2s from the past 2 years and pay stubs from the last 30 to 60 days. Your bank account information, including statements from all different bank accounts such as checking, savings, and retirement accounts. Any additional income or liability documents like dividends, overtime, pension, child support, and more. Finally, you'll need to show your Certificate of Eligibility, also known as your COE, in order to identify a few critical factors specific to you as a veteran or service member. Your lender can help you gain access to your COE. Once all of these documents are checked and approved, your loan officer will issue a pre-approval, which means you are ready to go to the next stage of the home buying process, home shopping. Last but not least, let's talk about the underwriting process. Underwriters are tasked with assessing the degree of risk that the lender or bank will face with the loan, so they can set fair and reasonable terms. Once a loan has been underwritten successfully, it can then be approved and finalized, and the home buying journey can come to a close. You may have heard two different types of underwriting being mentioned before: manual and automated. The main difference between the two is that manual underwriting requires an underwriter to review the application more in depth. Due to this extra labor, a lot of lenders don't do manual underwrites, but we do. Manual underwrites generally mean that the automated underwriting software, or AUS, typically called DU or LP, was unable to determine an acceptable risk threshold. Therefore, the underwriter has more discretion to approve or deny a loan based on the provided documentation. This can leave a lot of veterans worse for wear if they don't fit into the AUS cookie-cutter mold. In a previous video, we mentioned that our underwriters take a more holistic approach. A manually underwritten loan is that holistic approach in action. Since underwriters are thorough in their research, the process typically takes a few weeks. A good rule of thumb for borrowers to keep in mind is that the faster they submit all necessary documents, the faster the underwriting process moves. Well, that concludes this video. If you have any more questions about qualifying for a VA loan, please read the content below this video or get in touch with one of our team by clicking the Apply Now button in the top right-hand corner of the screen.